All right, let's talk about what's being said right now because there's a lot of excitement building, and I want to ground this properly before people start running with unrealistic expectations. Jake Claver is saying we're basically there, that depending on what Japan does with rates, Friday or Monday could be explosive. He's pointing directly at the carry trade unwind and suggesting that if the Bank of Japan goes aggressive, this thing could move fast. And I get why that narrative is gaining traction because on the surface it sounds clean. Japan raises rates, the yen carry trade unwinds, liquidity shifts, risk assets react, XRP benefits. Simple story, but markets are never that simple. And if you don't understand how this mechanism works, you're going to misread both the timing and the outcome. Let's start with what Jake actually said, because context matters. He laid out three scenarios. A 25 basis point hike would likely be a slow trickle. Nothing dramatic, no fireworks. But if Japan goes 50 or 75 basis points, that's when things get aggressive. That's when leverage positions tied to cheap yen funding start getting forced to unwind. That's when you see real stress in global markets. And yes, that's when you can see sharp moves in crypto. Now, here's the key detail people are glossing over. The market is already pricing in a hike. There's roughly a 98% probability that Japan raises rates, with 0.75% being the highest level they've seen in about 30 years. So the question is not if Japan hikes. The question is how much, and more importantly, how the market responds after the decision, not before it. For decades, the yen carry trade has been one of the quiet engines of global liquidity. Institutions borrow yen at near zero rates, convert it into other currencies, and deploy that capital into stocks, bonds, real estate, and crypto. It's cheap leverage. When Japan raises rates, that leverage becomes more expensive, and positions that only made sense under zero-rate conditions start to crack. When that unwind happens, it's not bullish in the short term. That's the part people need to hear clearly. Unwinds mean liquidation first. They mean volatility. They mean forced selling. Liquidity shocks don't start with price going straight up. They usually start with stress. So when people say this could be a happy Monday, they're jumping straight to the end of the movie without watching the first act. Could XRP benefit after liquidity reshuffles? Absolutely. Could XRP play a role if the current system starts showing cracks? Possibly. But those are second-order effects, not immediate reactions. And here's where I want to challenge a weak assumption that's floating around. The idea that XRP will explode because Japan raises rates is flawed. One thing does not directly cause the other. XRP doesn't pump just because a central bank tightens policy. What XRP responds to is where liquidity eventually flows, not where it temporarily breaks. If Japan tightening creates stress, the first reaction is risk off. That's not bullish for crypto in the immediate window. The opportunity comes later when capital looks for more efficient rails, better settlement, better yield, and lower friction. That's where XRP's thesis actually lives. So if you're waking up Monday morning expecting instant fireworks just because of a rate decision, you're setting yourself up for disappointment. And disappointment is what makes people sell at the wrong time. The real question you should be asking right now isn't, will price explode on Friday or Monday? It's, what happens to liquidity after leverage unwinds, and who benefits when the system needs better plumbing? Because that's where XRP actually enters the conversation, not as a hype asset, but as infrastructure. And in the next part, we're going to dig into why Ripple's position today looks very different than it did in past cycles, and why things like stablecoins, hidden road, treasury settlement, and yield change the equation entirely. Stay with me, because this is where the surface narrative breaks down and the real story begins. Now let's take this a step deeper, because this is where most people misunderstand what's actually unfolding. When carry trades unwind, the first phase is not opportunity, it's damage control. Funds don't rotate cleanly from one asset to another. They sell what they can, where they can, to reduce leverage. That means crypto, equities, and anything considered risk can get hit at the same time. So if Japan goes aggressive with a 50 or 75 basis point hike, the immediate reaction is not institutions piling into XRP. The immediate reaction is forced liquidation elsewhere. That's how these events have always worked. Liquidity doesn't teleport, it panics first. And this is why it's dangerous to anchor your expectations to a specific day like Friday or Monday. Markets don't move on your calendar, they move on balance sheets. If leverage starts coming off, that process can take days or weeks, not hours. Anyone promising instant upside is skipping the uncomfortable part of the process. But here's where XRP becomes interesting after the unwind. When leverage unwinds, two things happen. First, weak structures break. Second, capital starts looking for efficiency. Once the dust settles, institutions reassess where they can move value with less friction, less trapped capital, and better yield. That's the environment where XRP's use case actually matters. Think about what the current system looks like. Banks are sitting on trillions in dormant capital through Nostro and Vostro accounts just to move money across borders. That capital earns nothing. It's dead weight. In a higher rate world, dead capital is unacceptable. Every percentage point matters when you're managing trillions. Now imagine a system where that capital doesn't have to sit idle, where liquidity can be deployed, earn yield, and still be available instantly when needed. That's not a nice to have. That's a competitive advantage. And that's exactly the problem Ripple and XRP are designed to solve. This is why tying XRP's future to one macro event is missing the forest for the trees. Japan's rate hike isn't the catalyst, it's a stress test. Stress exposes inefficiencies. Inefficiencies create demand for better systems, and demand is what ultimately drives adoption. That's also why disappointment is built into short-term thinking. If you wake up Monday and nothing happened, that doesn't mean Jake was wrong about the bigger picture. It means you expected the outcome before the process played out. Real shifts don't announce themselves with fireworks. They show up as quiet changes in behavior. Liquidity starts flowing differently. Settlement preferences change. Institutions start favoring rails that weren't previously essential. And this is where Ripple's current position matters more than price. Ripple today is not what it was in 2017 or 2020. It now has a banking license path, a stablecoin, institutional prime brokerage through Hidden Road, and access to treasury-level settlement flows. That changes how XRP fits into the system after volatility, not during it. This is where the conversation shifts from macro theory to actual incentives, because institutions don't move capital based on narratives. They move it based on math. And when you start running the numbers, you understand why this transition isn't optional for banks and corporations anymore. Let's talk about trapped capital. Right now, the global banking system relies on the Nostro Vostro model, which forces banks to pre-fund accounts all over the world just to be able to move money when needed. That capital sits idle. It doesn't earn yield, it doesn't compound, it just waits. In a low-rate world, that inefficiency was tolerated. In a higher rate, tighter liquidity world, it becomes a liability. Now connect that to what's being built. If a bank can hold capital, earn even 1% to 3% yield, and still deploy that liquidity instantly when a payment needs to be made, the entire incentive structure changes. 1% on trillions of dollars is not small money. 2 or 3% is transformative. That's not retail yield farming. That's balance sheet optimization at a global scale. This is why Ripple's strategy matters. You've got a regulated stablecoin. You've got institutional prime brokerage through Hidden Road, now rebranded as Ripple Prime. You've got treasury settlement capabilities through acquisitions like G Treasury. And you've got XRP sitting at the center as the neutral liquidity bridge that makes instant settlement possible. Put all of that together, and you don't get a Coinbase competitor chasing retail traders. You get a back-end financial utility serving banks, corporations, and institutions that don't care about charts. They care about efficiency. And this is where people underestimate how fast behavior can change once the regulatory perimeter is clear enough. We already saw the Genius Act move stablecoin rulemaking forward in 2025. The Clarity Act is expected in 2026. Once those frameworks are in place, institutions don't debate whether to adopt. They debate how fast they can adopt without falling behind competitors. That's why yield is such a big deal here. Yield creates urgency. It creates pressure. It creates a measurable disadvantage for anyone who stays on legacy rails too long. No CFO wants to explain why their competitor earns more on idle capital simply because they upgraded infrastructure first. This is also why price action can lag while positioning accelerates. These systems don't get rolled out on exchanges. They get integrated quietly through pilots, partnerships, and private liquidity channels. You don't see fireworks while the groundwork is being laid. So when people say, nothing's happening, and what they really mean is like nothing visible is happening on my chart, meanwhile, incentives are shifting underneath the surface in a way that doesn't reverse. Now, this is where supply and demand enter the conversation, and this is the part that tends to make people uncomfortable because it challenges the idea that XRP will always be easy to get at any price. Up until now, a lot of demand has been absorbed quietly through OTC desks. Tens of millions of dollars worth of XRP moving day after day without lighting up the charts. That's not retail buying, that's positioning. OTC markets exist for one reason: to avoid slippage. Large players don't chase price on open exchanges. They negotiate supply privately at scale, and they do it patiently. But that approach only works as long as supply is available. And this is where things start getting interesting. There are only a few places where meaningful XRP liquidity can come from: exchanges, OTC desks, and Ripple itself through escrow. That's it. And each of those sources has constraints. Exchanges don't have infinite depth. OTC desks rely on willing sellers. And Ripple is not obligated to sell XRP on demand, especially if strategic use cases are already lined up. This is where people underestimate how fast conditions can change. As ETFs enter the picture, even at modest levels, they introduce persistent demand. Not hype-driven demand, but structural demand. WisdomTree managing over $100 billion is not the same as a niche product. CoinShares, 21 Shares, and others add layers of exposure. And while everyone is waiting for names like BlackRock or Fidelity to make a public move, the reality is they don't telegraph their positioning years in advance. They respond to client demand, regulatory readiness, and infrastructure maturity. And tokenization accelerates this further. Once real-world assets start moving on-chain, stocks, bonds, treasuries, funds, liquidity requirements change, settlement becomes faster, capital moves more frequently, and systems that rely on neutral bridge assets become more valuable, not less. XRP doesn't need to replace everything. It only needs to sit in the flows that matter. This is why people get blindsided when price finally moves. It's not because something new suddenly happened. It's because supply quietly dried up while demand became non-optional. That's when markets stop behaving rationally and start repricing aggressively. And to be clear, this doesn't mean a straight lineup. It never does. Volatility increases as markets transition. Weak hands exit, strong hands absorb, but the character of the market changes. Pullbacks become shallower, recoveries become faster, liquidity starts dictating price instead of sentiment. That's why focusing on a single rate decision or a single day misses the point. Those are sparks, not the fire. The fire is being built by regulation, yield, tokenization, and institutional behavior changing all at once. So let's bring this home properly, because this is where expectations need to be reset in a healthy way. What Jake Claver is pointing to, and what a lot of people are reacting to, is not a guarantee of a price explosion on a specific day. It's a recognition that the system is under stress, and stress is what exposes weak structures and accelerates change. That's it. Anyone promising that Friday or Monday must be a moon event is oversimplifying how capital actually moves. If Japan hikes aggressively and the carry trade unwinds hard, the first reaction can easily be messy. Volatility, drawdowns, confusion, disappointment, that's normal. That's how liquidity events work. XRP doesn't magically teleport higher just because something breaks elsewhere. What matters is what happens after the unwind, when institutions reassess where capital should live going forward. And that's where XRP's position becomes powerful. Ripple is no longer just a payments company with a token attached to it. You're looking at a stack now: a regulated stablecoin, institutional prime brokerage, treasury settlement, access to yield, and a neutral bridge asset that can move value instantly, globally, and 24/7. That combination didn't exist in prior cycles. That's why comparing this moment to 2017 or even 2020 is lazy analysis. At the same time, this does not mean overnight riches, straight-line price action, or that every XRP holder will magically win. Markets don't work like that. Transitions are uneven. They reward patience, not excitement. They reward understanding, not hype. The real risk right now isn't that nothing happens on Monday. The real risk is that people misinterpret silence or volatility as failure and exit right before the system starts demanding what XRP provides. Infrastructure doesn't announce itself with fireworks. It becomes obvious only after it's already embedded. So manage expectations. Don't anchor to dates. Don't let influencers sell you certainty where none exists. Focus on the phase we're in: regulatory alignment, institutional positioning, yield infrastructure, and tokenization going mainstream. Those are slow burns that lead to violent repricing later, not the other way around. And before we close, this is important to say clearly: none of this is financial advice. This is not a prediction, not a promise, and not a recommendation to buy, sell, or hold any asset. You should always do your own research, understand your own risk tolerance, and make decisions based on your personal financial situation. Crypto assets, including XRP, are volatile and carry risk. But if you understand what XRP is designed to do and why stress events accelerate adoption rather than stop it, then you stop obsessing over single days and start thinking in systems. That's where the real edge is. If you got value from this, let me know in the comments. I read them. Appreciate all of you for being here, staying curious, and thinking deeper than the headlines.